For 9 episodes, we tracked the forces trying to replace the dollar. China, BRICS, Bridge, SIPs, the gold return. All of it built by nations who wanted to escape the dollar's grip. But here is what nobody told you. The most dangerous threat to the dollar is not coming from Beijing. It is not coming from Moscow. It is not coming from the BRICS summit. It is coming from Washington, from the White House, from the people who are supposed to protect it. There is a plan, a written plan, published, signed, being executed right now. A plan to deliberately weaken the United States dollar. And the man running it is the President of the United States. To understand why America would want a weaker dollar, you have to understand what a strong dollar costs. This is called the Triffin dilemma, named after economist Robert Triffin, who figured it out in 1960. Here is the problem. To be the world's reserve currency, the dollar must be abundant. Every nation on Earth needs dollars, for trade, for debt, for reserves. The only way to supply the world with dollars is for America to run trade deficits, to buy more than it sells, to send dollars out and receive goods in. For 80 years, that is exactly what happened. America became the world's buyer, China became the world's factory, Germany became the world's engineer, Saudi Arabia became the world's gas station, and America? America became the world's financial center and lost 7 million manufacturing jobs. The reserve currency status that everyone assumes is America's greatest power came with a price. An entire industrial base. Hollowed out. Over 40 years. Because the strong dollar made it cheaper to build everything somewhere else. That is the bargain America made in 1944. And it is a bargain a significant portion of this administration no longer wants to keep. So what does America do when it decides the bargain is broken? It does what it did once before, in 1985, at the Plaza Hotel in New York City. September 22nd, 1985. The finance ministers of 5 nations walked into a hotel in Manhattan: the United States, West Germany, France, Britain, Japan. They signed an agreement, the Plaza Accord. The deal was simple. The US dollar was too strong. American exports were too expensive. The trade deficit was too large. So the 5 nations agreed to deliberately weaken the dollar through coordinated currency intervention. Within 2 years, the dollar fell 51% against the Japanese yen, 40% against the German mark. American exports became competitive again. The trade deficit shrank. The plan worked. But Japan paid a price. The forced appreciation of the yen triggered an asset bubble. Then a crash. Then a decade of economic stagnation that Japan calls to this day the lost decade. The Plaza Accord saved American manufacturing and broke the Japanese economy. That was 1985. What if someone tried to do it again, in 2025, without asking for permission? That is exactly what is happening. It has a name: the Mar-a-Lago Accord. In November 2024, before the inauguration, a man named Stephen Moran published a paper. Moran was a senior strategist at a major hedge fund. He would become the chair of the President's Council of Economic Advisors. The paper was called A User's Guide to Restructuring the Global Trading System. Most people never read it. They should have. Here is what it says. The paper argues that the dollar's reserve currency status is costing America its industrial base, that the Triffin dilemma is real, that America has been subsidizing the world's trade system at the expense of its own workers, and it proposes a solution. Use tariffs, not as a trade tool, as leverage. The logic: America imposes tariffs on trading partners. Tariffs create economic pressure. Trading partners who need access to the American market must negotiate. And the price of negotiation? Currency realignment. Allies agree to appreciate their currencies, which means the dollar falls, not by accident, by design. A new Plaza Accord. But this time, nobody is invited to the table. The terms are set in Washington, and the leverage is tariffs. This is the Mar-a-Lago Accord, the plan to deliberately restructure global currency markets using economic coercion. Now, the Plaza Accord worked on Japan because Japan was an ally. Japan needed America's military protection. Japan could not say no. China is not Japan. China does not need America's military protection. China is not dependent on American goodwill. China has options, and China's response to the tariffs has not been currency appreciation. China has done something more dangerous. It has done almost nothing. The yuan has moved, but not dramatically. China is absorbing the pressure because it knows something. Every day the tariff war continues, American companies pay more for Chinese goods. American consumers pay more for everything. American inflation rises. And the Federal Reserve faces a choice between fighting inflation and supporting growth. China is not fighting the tariffs. China is waiting for the tariffs to fight America. And while it waits, it is signing zero-tariff deals with Africa. It is expanding CIPS. It is testing Enbridge. The Mar-a-Lago Accord assumes the other side will fold. China is betting it won't have to. But here is the part nobody is talking about. The part that should alarm everyone who watched this series from the beginning. For 9 episodes, we watched the world build an alternative to the dollar system. CIPS, Enbridge, gold. The infrastructure of a post-dollar world. It was slow. It was deliberate. It was patient. But now, the United States government is accelerating the process. Think about what a deliberately weak dollar means. It means dollar-denominated assets become less attractive to foreign investors. Why hold U.S. treasuries if the dollar is being deliberately devalued? It means central banks have a new reason to diversify away from dollars. Not because they fear sanctions, but because the asset itself is being engineered to fall. It means the very reserve currency status that gives America its power, its ability to sanction, its ability to borrow cheaply, its ability to project force is being quietly, deliberately eroded. From the inside. The enemies of the dollar spent a decade building the exit. The Mar-a-Lago Accord may have just opened the door. The honest answer is maybe. The Plaza Accord did work. The U.S. manufacturing base did recover partially. A weaker dollar could make American exports competitive. It could narrow the trade deficit. It could bring factories back. If the allies comply, if China can be pressured, if the dollar doesn't fall too fast, if inflation stays contained, if confidence in U.S. treasuries holds. That is a lot of ifs. And the 1985 Plaza Accord had something the Mar-a-Lago Accord doesn't: consent. The 5 nations agreed, they coordinated, they managed the fall. The Mar-a-Lago Accord is coercion, unilateral, imposed. And coercion creates resentment. Resentment creates alternatives. Alternatives, we already know what they look like. CIPS, Enbridge, gold, a parallel system, already running. The world's enemies tried to replace the dollar. They built the pipes. They laid the rails. They bought the gold. Then America's own government decided the dollar was too strong and began pushing from the inside. The dollar is not under attack from one direction. It is under pressure from every direction, including its own. This does not mean it falls tomorrow. It does not mean it collapses next year. It means the system that has organized the world for 80 years is being renegotiated by its enemies, by its rivals, and now by its own architects. You are watching it happen in real time. Most people aren't watching. You are. If you watched the full 9-episode series, you already understand more than 99% of people watching the news. This is the 10th chapter. The story isn't over, it's accelerating. Subscribe, because the people who see what's coming are never caught off guard.